Hey traders, Jamie Saettele here with a special report on the British pound. It is February 8th, 2015. So in trading, everyone loves to talk about probabilities, right? But in reality, the big money is made in the possibilities. What I mean is specifically positioning for a possibility that's suggested by the weight of evidence while risking a small fraction of the potential profit. Over the next 20 to 30 trading days, it's possible the pound dollar falls close to 10 big figures or 1,000 pips. This probably sounds overly aggressive, especially given the still crowded nature of the long dollar trade, but let's take a look at the evidence. Okay, so this was published last Thursday. It's the implications from the first 20-day high after 144 days of not making a 20-day high or bearish. I'm going to expand on that. I'm going to show you some of the charts, okay, and what it looks like visually. So what we have here is a 20-day channel. Okay, all that means is this is the 20-day high, this is the 20-day low. I've got RSI here, and I've got a little script that I wrote to basically show how long between 20-day highs you have. Okay, so this means 144 means it was 144 days between 20-day highs. The last 20-day high was the day at the top on July 15th, 2014. Okay, so let's take a look at some of the other times we had this. There's only been 3 other times in history where the pound dollar went as long between 20-day highs as it did just recently. So 1981 and 1984 are the 2 that we're going to look at. The 1975 market is a little, different, if you will, a little odd. Back then, the data is not as, reliable. I have closing data, by the way, going back to the early 80s and 70s and whatnot, so I don't have the high or the low for that day, but it works. It's fine. All right, so 1981 and 1984 instances pound dollar declined 4% within 13 trading days from its new 20-day high. Okay, so 4% in pound dollar right now would be about 600 pips. Take a look at the 1981 and 1984 markets. So Mike and I both, we pay a good deal of attention to what we term like momentum or the RSI profile. Right, RSI exhibits specific characteristics in bull and bear markets. For example, bear market rallies tend to reverse when RSIs reach 50 to 60, and the indicator shouldn't exceed 70. So basically 60 is resistance in a bear market and 40 support in a bull market. Well, go back, this is the 1981 instance. You can see the very extended downtrend that we had without a 20-day high. Okay, in fact, there wasn't a 20-day high from January 21st, 1981 all the way to August 21st, 1981. That was actually 148 days, right? The recent time was 144 days. But look how RSI acted. You had all this string of oversold readings, right? And then RSI popped up to right to 60 and made that 20-day high and rolled over right away. From August 21st to September 11th. What's that, about 3 weeks? Pound dollar fell to the bottom of its range, which was about 1,000 pips. Okay, back then, from about 187.65 to 177.90. Okay, so you can see the what happened there in 1981. 1984. 1984, we've got, it's this one. So 1984, you can see we had, didn't have a 20-day high all the way from February 29th, 1984, all the way until November 5th, 1984, November 2nd, 1984. Okay, so you get the first high on November 2nd, just as RSI reached 60. Okay, now the top was not until November 7th, and RSI did reach 66. Okay, but it didn't exceed 70. The ensuing decline was absolutely magnificent. Cable fell from above 127 to just above 105 in a little less than 3 months. Okay, so again, we had a string of oversold levels. RSI popped up to 60, did go a little above it, and then you had a very, large continuation of a big bear market. So fast forward to now, and we've got, again, big bear market, continually oversold indicator. First 20-day high, we actually made a J spike on Friday. And RSI, so far the high in RSI is 56.5, so kind of right in line with, the RSI profile of a bear market. All right, let's look at another daily chart here we found. All right, so you can see that cable came up, filled the gap from January 5th. Okay, we've also got channel resistance. We've got a former support line here that acted as resistance almost to the tick on Friday. If I go intraday, you Elliott wavers out there, you'll notice what is called a complex correction. Okay, triple three. This is called a triple three, labeled WXY. Okay, if you really want to get into the details, what you do is you have three wave movements everywhere. A, B, C, right? W, A, B, C. This is the X. Then A, B, C. This is the Y. And wave Y is actually just about equal to 61.8% of wave W, okay, which is also the gap. So you've got a very nice setup from an Elliott wave perspective as well. Of course, there's been a lot of talk about a possible inverse head and shoulders, right? With this being the shoulder, the head, the shoulder, okay, the break of the neckline right here. Now, this is still a possibility. If the market gets back under this neckline, it will be a pretty strong indication that you actually have a failed reversal pattern, and failed reversal patterns often lead to powerful moves in the direction of the larger trend that it was trying to reverse, which in this case would be down. So there's a lot going on here from a technical perspective. Let's take a look at seasonality. Okay, the seasonal tendency for pound dollar is actually really quite bearish based on 5, 10, and 20-year studies from mid-January, okay, the week of the 16th, into the first week of March. Okay, there's the 5, 10, and 20-year studies here. The 15-year study turns bearish after this week, so after the 13th of February, and remains so until the week of March 20th. Okay, so we've got the wind at our back, so to speak, with regards to seasonal tendencies on the downside. Now, let's look at some longer-term levels for the British pound. Okay, you've got this slightly upward sloping upper parallel here. This is the line, the slope originally off of the high from 2011 and the high from last year in 2014. You can see that you've had several influences on this slope. Just recently, we bounced from the one that extends off the 2013 low. This is actually, the parallel is the main reason we were long last week. Okay, this parallel right here. If this thing gives way, I guess you could get some support the next parallel right here, in the mid 148s. But the long-term target here is the lower parallel from this structure, this median line structure. I give this structure weight for several reasons. First, there's some touches here in late. Zoom in a little bit. There's some touches here in late 2012. You had a good deal of consolidation for several months in 2013 before the thing broke out to the upside, albeit that trend was extremely choppy. But most importantly, is what happened recently. Okay, you can see after the downside break in November, the median line acted as a ceiling. Zoom in even more to show you that. Okay, the median line acted as a ceiling, for 1, 2, 3, about 4 weeks in a row. Suggests we're dealing with the right slope. Basically, when you see action like this, okay, suggests you're dealing with the right lines on your chart. And after a market breaks a median line, okay, especially after it breaks it, retests it, breaks down again, the logical place for a market to go is to the lower parallel, right? And in this case, lower parallel, which is this line here, okay, actually intersects the final upper parallel from the structure that we were looking at here and here, the one we were long off of, but this is the one that extends from the 2009 low. It intersects this upper parallel. Guess when? The week of March 6th. That's the date for the seasonal low in the British pound, and it happens to be at about 143.50, which is really fairly close to the 2010 low at 142.30. Okay, so remember, early March is important from a seasonality perspective, but there's a really nice confluence there. It's a nice confluence in price and time from a seasonal perspective. So, just a good argument that the British pound could be around 143.50 at the beginning or middle of March. All right. Okay, so take a look at the intraday chart now. I've laid out, a technical argument for a sharp decline over the next 4 to 6 weeks. But where is the trade, right? Well, first of all, since even the best plans don't pan out, stops are critical, obviously, always a must. And in this case, 153.55 would probably be the area for the first stop placement. Okay, I'll be tracking for a high between about 152.80 and 152.98. That's just the 50 to 61.8 retracements of the decline from the high that we had here last week. Obviously, we don't know how the market's going to open. Market's not open yet here on Sunday, but assuming we open fairly close to where we are, I'd be looking for resistance again, 52.80 to 53. 52.94 is a very high volume level, so that's a specific price point to keep in mind. If things start playing out on the downside, we'll be looking to identify short-term median line structures to aid in trading the pound dollar lower. Now, notice I haven't put any targets on this yet, because with the potential for such a big decline to occur, you don't want to limit, what you get. If things start playing out, we'll look to trade the position, so to speak, and take some off at what we deem as, minor price lows and sell more on minor price highs, etc., etc. Okay, so that is the pound dollar. Finally, I actually do want to show you another chart. Keep an eye on the pound Aussie here. That's a weekly chart. Remember, Aussie dollar had a large range reversal last Tuesday, and pound Aussie has broken out higher. Okay, we're at the highest levels we've been at since 2009, August 2009. In fact, resistance has come in from the May 2009 low here, just right now. But again, pound Aussie is at channel resistance here. Okay, the rally from the September low, if you look at a daily chart, is overlapping, right? Overlapping. What I mean is this low overlaps this high, which raises the possibility of what's known in Elliott wave as an ending diagonal. Ending diagonals are fully retraced most times, so the implication would be for a decline all the way back to 172, the September low. Again, RSI, there's divergence on the weekly chart. You can see divergence here. You've got RSI below 70. That's a good thing. On the daily chart, RSI is above 70. Okay, we do have a slight divergence here. It is above 70, so this is one that I would necessarily pay attention to, but the weekly is there, so that's important. And the 4-hour chart, the 240-minute chart, shows a very good divergence. When you're looking at divergences, you want to look at the closes. You can see we actually did have a new closing high. Closes because RSI is calculated with closes. So we had a new closing high here just recently. on, I guess that was Thursday, and RSI is extremely divergent. So the 4-hour chart, or the 4-hour RSI divergence, and the weekly RSI divergence is the kind of divergence that you want to see, you want to pay attention to. So look, I don't see an entry just yet in Pound Aussie, but that could obviously change quickly. So we'll be focusing on that as well. Okay, that's it. Again, this is a special report on the British pound for February 8th, 2015. And if things start playing out as suggested by all this technical information, we'll look to do fairly well in the several weeks ahead with the British pound. All right, take care. Good luck.